we have learned in the previous class. So let's start now. Let me just share the screen. Uh, okay. Okay, let me put the. All right. Bismillah wassalatu wassalamu ala rasulillah. Maybe I can do some just a brief recap what we gone through last week. Sorry, where's my pen? Okay. All right. Okay. All right. We have gone through. I think that there are 6 components of financial system, right? We discussed them individually briefly, right? But as I promised to you, as we go through along the topics starting from today, we're going to look at the components in a more detailed explanation. So today, what we're going to do is we're going to discuss the first component, which is money, right? So of course, in a financial system, you have a money, and then for basically keeping the value, right, the wealth, to storing your wealth, and then as we are progressing towards becoming more efficient in the economy, we also demand some instrument that not just function as for storing the value, but also can give some returns as well, right? So that's why we have a different type of financial instrument. Okay, so this is the first component, right? And this is the second one, right? And of course, in a financial system, you have a contracting party, right? People who are interested. So basically, one party have limited resources. Okay. What I mean, in term of, for the sake of our discussion, we are concerning about the financial resources or the economic resources. Okay. And then, but they can offer like skills or businesses. Okay. But basically, you don't have enough capital, right? And then you have another party that have abundance of resources, right? But they are looking for some business opportunity. Okay. To link these two party, right? Can you hear my voice clearly, or there is some background noise? Is it clear now?
Yes, clear.
Okay. All right.
Yeah,
So
it's clear.
so then we look at the financial institution, right? We discussed this last week. The job of financial institution is basically to intermediate, right, between with 2 group of contracting parties, right? In the case of banks, for example, this party with resources is commonly we see in the case of depositors, right? Where they deposit their money throughout the time, and then the bank will use the money, the deposited money, to give out loans. Okay, right. So that's the function of the banks. Okay, and then this basically the borrower. Okay, this financial intermediation function is a way that we do what we call as indirect finance, right? I think we've touched this a bit towards the end of the class. Indirect finance, meaning that there are some intermediaries, usually banks or investment managers, that will, allocating these resources to those party who need the resources or capital. Okay, so this financial institution is the third component, right? And then you have, okay, right, then you have what we call as the financial market, right? Where all this financial and lending activity will take place, right? So I briefly explained to you, we can divide the financial market into two, right? Usually we divide it into equity markets, and debt market. Okay, equity market, is dealing with stocks where company listing out their shares to be owned by public, right? It's basically they delinquishing their ownership to be owned by public so that they can get or they can generate some capital for their business operation. So that's the job of stock markets. We are going to look at that, I think, in the week 5 or 6. I don't remember exactly, right? And then we can further look at that market into two, right? So the first one is the money market. It's for the instrument that traded less than 12 months. Because every financial instruments have the maturity, right? So let's say you buy a bond from a company, okay, for that have a maturity of 12 months, right? Okay, so unlike stocks, it doesn't have maturity by default, right? Because you can hold the ownership of the company as long as you want, except that when the company go into a default and liquidation, right? And then you have to liquidate your ownership as well. But usually for the debt instruments, you have some maturities. That attached to that financial instruments. And I explained to you the role of central banks, right? I mean, in terms of implementing the monetary policy using interbank, for example, interbanks money market instruments. We're going to look at that in detail in the following weeks. The second category of that market is what we call as the capital market. In the Islamic financial system, we have the Islamic capital markets. You have bond and sukuk, okay, that usually lasts more than 12 months. So this is just the how they categorize the debt markets. Okay, so this is the fourth components of a financial system. Okay, and we know that there is a central banks or regulators that will govern the operation of this
Doctor, what's the difference
system
between financial instruments and financial markets?
Financial instrument is the instrument that has been traded, like bond, right? Stocks. So those are financial instruments because it can keep your wealth, right? One thing, and then the second thing is that you can use it to generate some of the return as well, right? Or you may incur some losses, right? But so that's financial instrument. But financial market is where this financial instrument is traded, right? So for the equity markets, you have the stock exchange. Like in Malaysia, we have a Bursa Malaysia, okay, and you have a commodity exchange as well, where you want to buy gold, silver, crude palm oil. So those are basically can be purchased if you enter into this commodity exchange, right? It doesn't have to be a physical exchange. Nowadays, there's a lot of what we call as this online commodity exchange, also stock exchange market that you can explore. So that's the difference between financial instrument and financial markets, right? But just the way that we describe or we categorize financial market is according to the instrument that has been traded within the specific financial markets. Okay, is that clear?
Yes, yes.
Okay, all right. So, and then apart from the central bank and the regulators that will oversee and supervise the financial system, we also have standard setting body, right? We have look at BIS, IOSCO, right? So they provide governing standards for those central banks, and then this central bank basically will ask the individual banks, the licensed bank, to operate in accordance to the standard have been set by these standard setting bodies, right? The objective I mentioned to you that they have a different mandates, right? For example, BIS, their mandates is basically within the banking system, right? So they are concerned about the stability of banking markets across country. So, and then IOSCO is concerned about the stability of the capital markets, right? In the debt markets, that deal with SUKO, with mutual funds, right? So they also set their own standard that will be followed by those central banks that oversee their respective country financial markets. Okay. And in Islamic financial system, we have IFSB, Islamic Financial Services Board. They have the office in Sasana Kijang. Right? Sasana Kijang is the headquarters of our central banks, right? Bank Negara Malaysia. So they have one office there. So the job of IFSB is basically to complement this BIS and IOSCO, and also if I'm not mistaken, is IAIS for the insurance standards. So they will come up with the standards that suit the characteristic or the features of Islamic financial instruments, right? Because we know that Islamic financial instrument deals with several limitations, right? In terms of the Sharia restrictions, you cannot deal with interest, you cannot deal with gharar, right? So you need those standards to be a bit amended, that so that we can so that this individual Islamic banks can also apply the same rule. So that's the job of IFSB, basically. All right, but they also conduct some training as well, right? If you exposed to them, they probably do the training, but they don't offer the training to public. They usually do the training for the central bankers, right? Sometimes it also involves the licensed bank as well. Okay, so that is the last component. That's a component number. This is number 5, and this is number 6. Okay, so together you can see they make the entire complete financial system, right? Different countries have a different extent of applying this or operating this financial system, right? But usually they especially in the developed and developing countries, they have this kind of components. So any question that you want to ask before we move into new topics today? You are not clear with anything that you can ask? Any question? No?
So, what about financial management?
Sorry, financial management?
Yeah.
Financial management.
Yeah. Is it
so what?
Is it among the components? 6.1.
So yeah, financial management is basically a practice, right? I mean, if you are asset managers, for example, you need to advise your client. So you may need some skills and expertise in terms of financial management, right? You need to advise your company where to invest, right? Perhaps you may do some calculation in terms of the expected returns according to different level of risk, right? So that's involved financial management, right? But what I'm talking here is basically the structure or the components of financial system, right? Financial management is a practice, right? Of course, it involves financial management here, right? In the case of intermediaries just now, if you want to allocate the resources, right? If you get the deposited money from your depositors, you need to apply some principle of financial management in order for you to identify the profitable portfolios where you can invest the money at. All right. So that's basically the financial management. You will take this class, I think they call it financial management analysis, after you complete the financial this prerequisite course. Right. We're going to look at some of the elements, but very briefly. For example, the application of present value, right? In order for you to estimate or to value certain financial asset, you need this principle of present value, right? Using by applying some interest rate, and then you can price certain financial instrument, financial asset. So that's part of the financial management. Okay.
Okay.
All right. Okay. All right. So can I move? Right. So I'm supposed to finish the lecture number 1 last week, but we didn't get enough time. So I'm going to continue with the second part of the first lecture, which we're going to look at the several principles of money and banking. Right? So in order for you to explain the nature or the characteristic of the financial system that we have looked at earlier, I mean this one, and also to describe the financial activities that take place within this financial system, you need to comprehend these 5 principles that govern these financial activities, right? It involves 5 elements. The first one is time, risk, information, markets, and stability. All right. So now let's look at the first one. The first principle tells us that time has value. I think if you are a Muamalat student, we have some here, right? I think Bailo, you are with a Muamalat background, right? And I think Munira as well. You are so have you heard the concept of time value of money? Can I confirm this? Have you heard this time value of money?
Yeah.
Okay, all right. And it has some very extensive debate within Sharia as well, right? Some people say that we should accept this concept of time value of money, and some disagree, right? And then if you disagree, basically you disagree with the entire finance operation, right? Because we basically dealing every day. I mean, every financial activity is financial transaction involve this concept of time value of money. So if you don't agree with this concept of time value of money, then perhaps you may come up with some entire new concept that will provide an alternative to the conventional time value of money that we kind of accept it universally, right? So the time value of money, so let me just explain using this, right? So time value of money. The concept of time value of money is originated in economy, right? In economics, you have this concept of opportunity cost. So everything you do, basically opportunity cost saying that everything you do have a consequences, right? So for example, I put in this situation. So now let's say I have amount of money of 1,000, right? And then somebody approached me and say that, can I, because I don't use this money, I don't need this, I don't need to use this money at the moment, because this is basically my disposable income, right? So I have enough to cover my expenses and everything. Then I have 1,000 left for the month, right? So somebody approached me and said that, can I take the 1,000, this 1,000 worth of money from you, and then perhaps in the next month, I will repay you back, right? So this guy will repay me back of 1,000, right? Plus some return, right? Okay, right. So through the conventional wisdom, right? The way the Westerners think about this concept of returns when you lend somebody money, right? It's pretty much because of we have different options, right, that we can place the money at, right? So perhaps if I don't give the money to this guy, right, I could have used the money for other things, right? There's a lot of opportunity, other option that I can use, right? So the first one, probably I can use it for myself, right? Or the second one, perhaps I can just deposit the money in a bank account where I can get some return as well, right? Or the third option, perhaps I may want to open a business venture, right? I may buy goods and then sells at a higher price, right? So I can get some return as well if I open a business using the money. So the question here is that, why should I lend you money, right? The answer to that is that because I want to get some return out of it, right? It's a nature of human. You cannot deny this, right? Everyone is expecting something because we basically are a self-driven human being, right? So every decision you make is basically based on your self-interest, right? That's the basic concept of economics. So the question here, right? Because I don't want to go into details here because I'm not from a Sharia background, right? So what is the perspective of Sharia? Let's say we just ask this a brief question here. So can we say that this additional income, so not additional income, the returns here is legit, right? So should I be compensated with these returns? Because basically I'm losing other opportunity to make money, to make more money out of the 1,000, right? Should I be compensated with this? So anyone want to give the idea? I would like to hear from Bailo and Monira. Perhaps you can give some, what is the Sharia view on this? Because this is basically dealing with, this return is calculated from interest, right? So if you allow this, will you say that you basically allow interest-based transaction? So that's the question here. Bailo, you want to respond, or you want to give some what you understand from?
Can you formulate again the question?
No, I want to. You following what I explained earlier, right?
Yeah,
Okay.
I'm following.
So what is the Sharia deliberation on this? What is how Sharia view this concept of time value of money?
Yeah,
from your understanding.
From borrowing and lending, it prohibits interest. Like you cannot borrow, you cannot lend someone and expect to gain interest out of that.
So you were saying that if I lend this 1,000 from this guy here, then I should be getting 1,000 back after 1 month. So 1,000 for 1,000 for the next 1 month. So there will be no return.
No
Oh.
return. Yeah.
Okay. Anyone have a different view? Anyone?
Like, I mean, in the Islamic perspective, lending, you should not have interest out of it. It's just like you have to be, like maybe you will get the reward afterwards. Even if you don't get the interest here, you will have the reward afterwards, like in the akhirah.
Okay.
But you should not, it's not like instant here, like you lend someone and you get the interest here. You
Yeah,
have to wait.
Yeah. So that's the principle of, I mean, the Islamic principles
Yeah.
that have been taught by our prophet, right?
Yeah.
So if somebody having difficulty that need the money, you should help him, right? And then by
Yeah, you
giving him
should
money,
help them.
all right. And then you shouldn't expect some return. Maybe you can get return in the hereafter, perhaps. Okay?
Yeah.
All right. But if you explain that to a Muslim, perhaps they get it, right? Because we are believers. We believe in this concept of getting a reward in the hereafter, right? The delayed the benefits in the world for the sake of getting a pleasure from God's, right? And then you can get some rewards after that in the hereafter, right? But how do you explain this to a non-Muslim who doesn't believe this in this hereafter? Can you deny his or her inclination to get some return out of the money, because he's losing out here? Basically, I'm losing out here. I don't. If I just lend the money out, I mean, now, then perhaps I'll just get the same amount of money in the next month. So how do you say that to a non-Muslim? Munira, you have anything, or anyone else you want to say this?
If me, I
Okay.
would impose like management fee or maybe late payment fee.
Okay. All right. So you are thinking something else, right? As a reward. So you accept the fact that they need to be compensated, right? You agree, Amira?
Right. Even if I'm not mistaken, I think Prophet also said that the lender should not impose any interest, but the borrower should
Yeah.
do something, maybe extra something like that. If I'm not mistaken.
Okay. Right. Okay. So that's a beauty of Islam, right? I mean, you cannot go against the human nature, right? Islam accept and welcome this concept of time value of money, but it has to be slightly different from what has been practiced in the interest-based or conventional banking system, right? Because what conventional banking does is basically they impose some fixed amount of return here. Let's say, let me just use another color. So let's say I've just imposed to this guy, let's say in the next month you pay me 1,000 with, let's say, 5% return, right? So I don't care if you are not making money. Let's say you use my money 1,000 to open a business. I don't care whether you are let's say you are doing a business and then you are not generating money. I don't care, right? Because basically what I'm interested now is basically the repayment of the loan, and then you need to give me some return of it, like 5%, right? And then another criticism on the conventional and interest-based system is that the poorer you are, I mean, you are deemed as high-risk borrowers, right? And then when you are a high-risk borrower, these banks will charge you with higher interest rate, right? The poorer you are, I mean, the more difficult for you to get the loans, and then basically the cost for you to borrow the money, to borrow the loan, is basically higher than those who have a low risk, right? So is it fair? That's the question now. So that's where and how you can distinguish between what we practice or what we've been taught by our prophet and what have been practiced in the conventional banking system. So that's the entirely difference, okay? And then some of the concept in Islamic banks. I don't have intention to discuss on Islamic banking, because I want you to get the basic foundation first, right? So that when you go taking another class, and then you can see the beauty of Islamic banking product or instrument. Okay, but what we just discussed here briefly. Okay, and then in the concept of in the Islamic banking system, you have this concept of ijara, of fee base. That's what Amira mentioned earlier, right? So there's an alternative instrument offered here, right, to facilitate the need of this capital holder to be compensated by giving out their monies, right, to others, because you cannot deny the facts, right? You cannot go against the human instinct who want, get some return from the investment or the financing that they made to others, right? You cannot deny that. That's the concept. Uh, so now that's the concept of time value of money. Can you understand? I mean, because of the delayed use of money, right? Because I'm refraining myself from using the money that I have now, because I give some to somebody else so that he can use for their business operation or their consumption. Hence, I need some return as well. So that's why I deserve those kind of return. So this is the concept of time value of money. Anyone want to add here, or you want to further clarification? Okay.
So basically, like in terms of lending and borrowing, Islamically speaking, the time value of money is not applicable.
It is applicable in Islamic finance, but in a different way. That's the intention here that I mentioned earlier, right? Because you might argue that what we have in the conventional banking now is kind of unjust to certain people, right? Because you're imposing certain fixed, not I mean, although some finance you have a fixed return as well, but usually there will be underlying business activity, right? There's a long discussion if I want to go there, but you will get to know
I understand. Like you have other opportunities how to get something out of that money.
Right.
Okay.
Yeah, so that's actually the difference between this because if you there are extreme group of people who say that we shouldn't embrace, I mean, we shouldn't take this time value of money, but again the thing is that you go against the nature, right? I mean, you there's no risk and reward here. If there is no risk and reward here, so what's the point of engage in the financial transaction, right? So you cannot give the argument of the reward in the hereafter to somebody who doesn't understand this, right? Who doesn't have the same level of religiosity as you, right? But you always that's where Islamic banking started, right? Because we want to give some alternative to the I would say it's a broken system, because you see what happened during the financial crisis, right? The entire system is just collapsed because we have this kind of practices, right? You become too greedy, you become too money driven, and then suddenly you just go against the ethics and also the principle of business transaction, right? Because you are too opportunistic, right? I mean, I'm not saying that in Islamic finance you cannot be opportunistic. You should be opportunistic, otherwise the system will not develop, right? But I hope you'll get more detail of that when you discuss Islamic banking practice in the next, right? So, but okay, now we ask the next question, right? So now we agree that we need to accept this concept of time value of money, right? Okay, so now the next question is that how much, right? Okay, right? Okay, so remember I mentioned to you that I had several other opportunities here, right? So usually people use, so this is where the concept of interest comes, right? Because I have this business opportunity here, right? So the measure that the finance people use in the markets is where they look at the risk-free asset. Okay. You have the government bonds, the T-bills, and etc. You will get to know this later after this, right? So let's say if I don't give the money to you, right? I don't give 1,000 to you, and then I invest this so-called as the free risk asset, right? So I don't, for sure, because risk-free asset, meaning that there's a very limited, or if not none, risk attached to that investment, right? Meaning that for sure, in the next 1 month, I will get my 1,000 back, plus with some return here for this risk-free assets. Okay. So if I want to decide how much return that I want to get from this borrower in the earlier case just now, so I should use this risk-free asset as my benchmark. Okay, so this is the interest rate concept came about.
What do you mean by risk-free?
Risk-free is I mentioned earlier, right? If I don't give this money 1,000 to this guy, so let's say I put my 1,000 here in a risk-free asset. Usually, risk-free asset is government is the bond issued by short-term bond issued. Bond is basically a certificate, right? Let's say the government. Okay, so now I need to explain what is the. Let's say you have a government here, right? So the government need a money from the investors. You have investors here, okay? So let's say the government needs the money for infrastructure, okay? So they will issue me a certificates, right? Let's say now T-bills, we are dealing with a short period of time. Okay, let's say in a 3 months time. Okay, so the government will issue a certificates, right? This bond, this is what we call bond, right? And then I'll need to purchase, as an investor, I'll need to purchase this bond with a certain amount of money, right? And then after 3 months, I will get some returns from the government, right? But why we call it is a risk-free? Why government we call it as a risk-free? Because the government will not, it's very uncommon for government to go into default, right? Unlike a corporate firms. If a corporate firms, if something happen, if COVID happen, right? So those company will get liquidated, for example. But in the case of government, right? For example, the government of Malaysia, they will be there forever, right? So you don't have to worry about getting repaid. You get what I mean, Sundus? So that's what we call. Clear? Okay. Are you following?
Yeah.
Okay. So that's why we call it as a risk-free asset, right? So that's why I should come back to the earlier transaction here between me and this borrower, right? So if I want to charge, I'm not talking about Islamic practice now, but let's say I'm in the conventional practice now. Okay, so let's say if I want to charge this borrower a certain amount of money, right? So risk-free asset returns should give me a good benchmark, right? Because if I, let's say, lend my money to this guy, to this borrower, I should be expecting that the return should be higher than risk-free asset. Why? Because I mentioned earlier, this guy could be in a certain level of risk as well, right? He might do a business and then the business fails, right? And then he will not be able to repay me back, right? So that's why he's a bit risky as compared to lending to government, right? Because if I lending to the government by purchasing of bonds and other certificates, I will get that return back with some returns, right? But in case of this guy, this borrower, I need to charge a bit extra because of what? Because of I'm expecting that there will be some risk that I need to bear in terms of, what if he will not be able to repay me back, right? So you can apply this concept in banking. So the same concept in banking as well, right? Let's say you put in my situation here is a bank, right? And then this is borrower. This guy is a borrower. Like any common is whether it's a corporate or a retail borrower, right? So the same idea and the same notion will take place here, right? So do you get the concept of time value of money here? Any question that you want to ask?
Like, doctor,
Okay.
that means if it is a risk, like if it's not a risk free, you have to charge more interest.
Yeah. Depending on the risk factors of that potential borrowers. Yes, some people could be risky, right? So and then this borrower may not be an individual. Banks also lend money to corporation, right? So different corporation and different firms have different level of risk, right? So they will do credit assessment as usual, right? So we're going to look at that after this in the next principle. So that's the first principle here. And so far, I hope you are clear with this so that I can move to the next principle. Okay, Bailo?
Yes, it's clear.
Okay. All right. Yeah, Munira. Yeah. Go on.
That time has been.
Tak clear, Munira. No, I don't hear your voice clearly.
The principle says that
The principle what? Come again?
time has value, right?
Okay.
So does that mean the longer the time the borrower took to repay the money?
Yeah. Okay. So yeah. So that's the concept of time value of money, right? Because the longer that's a good point that Munira has raised. All right. Let's say this, right? So let's say in the case just now, I have this one option to give to borrower number one, which will take place which will pay me back in 1 month time. Okay. And then I have a second borrower, right? This second borrower borrow the same amount from me, right? Which is 1,000, right? Okay, but this second borrower will repay me in 3 months, right? So which one you think that have a higher risk here? The first or the second?
Second one.
Right. That's so. Should I ask more return from him, Munira?
Yes.
I should, right? So that's the concept of time value of money as well, right? So the longer periods that you hold from getting the repayment, so you should expect the more returns the lender should expect more returns from that. Right? Let's say you apply a car loan, for example, right? If you go to any banks and you're asking for auto financing, right? So and then they will calculate the loan for you. If you borrow for 5 years, you need to let's say you need to repay back with a return of let's say 10,000. Right? You're buying an expensive car apparently, right? 10,000, right? But if you say that, can I extend a bit the time, like for 9 years perhaps, and then you will see that you need to repay the return a bit higher. Perhaps you need to repay 12,000 plus with the principal that the amount that you borrowed, right? So that's the same concept here in finance. It applies everywhere. This concept of time value of money. Okay, Mira. All right. Okay. All right. So if you look at here, right? So coming back to the things that Munira asked earlier, right? So if you look at the red color, sorry, The red is basically the 20 years maturity bond, right? And then the green color is what? 3 months, right? 3 months. And then the blue one is 3 to 5 year average, 3 to 5 year average. You can see that the return, the interest rate for 20 years of bond is definitely higher than those two, right? With a shorter period of maturity. You kind of expect that, right? But in during certain time, like for example, I think this is where the crisis take place, right? You will see that a bit of convergence, right? Because people are changing their preference, right? Like during the crisis, people are expecting to get more fast return, right? I don't want to put my money into a long-term investment when there is crisis, right? Because it's too risky. So people are demanding for short-term financial instrument like these 3 months T-bills, right? So if when there is a high demand for T-bills, short-term financial instrument, so what happened is that the same concept of demand and supply, right? When there is a high demand, what happened to the price of this financial instrument? It will spike, right? So you'll see here, I think this is during the crisis. You see here in global financial crisis as well, GFC recently, 2008 and 2009 here, right? You see some convergence here. Can you see that on the screen? So I mean, in finance, dealing with the same concept of demand and supply, you cannot run from this beauty concept of demand and supply, right? Okay. Okay, that's only one principle, right? We have how many? I might not finish the lecture again this time. So it's okay, right? I mean, we take it slowly, right? Hopefully we cover everything after this. So so this is the recent phenomenon in many banking markets, especially in those European markets and also in Asian markets, in Japan, right? So what happened in Japan? Let me explain to you very quickly because I have to move to the next principle. So you can apply the same concept of demand and supply for financial resources here. Same thing, right? So what happened in Japan, right? Recently is that Japan has a very high aging population, right? So meaning that they live longer, right? So they reach until 60s above, 70s above, right? So most of them are retired population, right? So usually when you retire, I mean, you don't want to take any risk, right? You just want to keep in the. Is there a voice? Okay, sorry. Can you hear my voice? Can you? All right.
Yeah, it's clear.
Okay. All right. Okay. So in Japan, you have a aging population, right? So they just in their retirement, right, in their pension, they just want to live their end of life, right? So they just whatever they earn during their employment, so they keep in the bank, right? So what this is the problem faced by the government in Japan, right? So because too many people are putting the money in savings, right? So the job of the Japanese government is basically to encourage these people to bring out the money from the savings to invest in their economic activity, right? Because when there is too many money saved or deposited in a bank account, so you basically have a less capital to be invested for business operation, right? So it's not good for the country, right? So how you going to do this, right? Is you can basically guess is that you need to discourage people from save more money, right? Because in other country, you might have a different mission, right? Different country want to keep the saving more so that you want to keep the inflation rate at certain low level, right? But in Japan, they have a different sort of problem, right? Because they need more money to be for consumption, especially, right, and for investment as well. So they have to discourage these people, right, from putting all the money safe in the account, right? So they need to ask them to bring out the money and then spend in the economy, right? So this is the concept of negative interest rate, right? So instead of I'm as a bank need to pay you certain amount of return if you deposit the money at my bank. So now instead of that, I'm charging you money, right? I'm charging you a certain cost if you keep the money here in my account. So can you get the concept of negative interest rate? So what happens if you have a negative interest rate here? Is you go against the concept of time value of money earlier. Remember that we have discussed earlier, right? Because you say that I don't need to pay you return, but instead I'm charging you, right? I'm charging you money because you keep the money from at my bank, right? So you will see that this concept of interest rate is going again the concept of time value of money, right? But you will see here, right? They still at a very low level of negative, right? It's still below than negative 1%. And it only happened during between central banks and individual banks, right? I think we have discussed this in the last class, right? So let's say the Central Bank of Japan here, right, impose a negative interest rate to Japanese bank, right? And then Japanese bank will use the capital to borrower, like us, individual borrowers, right? So Central Bank of Japan impose negative rate here to banks, right? Because remember they have to keep some money at central bank account. That's compulsory. That's a mandatory for them, right? If this bank keep the money at the central bank level, they by right they should get some return, right? But in this case of Japan, this bank will be charged by the central banks by a certain amount of money. This is what we call as the negative interest rate. But because of the amount of negative interest rate is still very low, this Japanese bank will decide to absorb this cost rather than, channel this cost to those borrowers, right? Because if they channel this negative interest rate to borrowers, what happened to those borrowers? You basically have people are queuing up at the ATM, want to deposit the money out from the bank, right? And then this bank basically losing out to other competitors, right? So as for now, although you will see the negative interest rate here in Japan, in Euro countries, but it only take place here within central banks and the commercial banks, right? It has yet to be, the impact has yet to be, channeled or transferred to borrowers, those people on the street, right? But what if you expect that this interest rate will go down a bit deeper? So what you expect is basically this bank will charge or will transfer the negative interest rate to borrowers, right? We will see that if that level is at that percentage is negative percentage is keep increasing, right? So okay, right. So let me just move quickly. All right. Somehow this second principle saying that risk required compensation, we have discussed that in the first principle, right? I think I have summarized in terms of different borrowers have a different level of risk, right? So the higher the risk, the higher the amount of return that I should be expecting as a borrower, right? As a lender, right? Okay. And let me be clear with you this one more thing, right? The concept of risk shifting and risk sharing, right? This is entirely two different things, right? You have seen the risk shifting application in conventional banking. Remember, we discussed earlier about the case of myself and this borrower earlier, right? So when I lend the 1,000, I don't care whether he is going to do well in his business or he's going to get a return from the money borrowed, right? Because at the end I just expecting the returns, the repayments, and also the returns, right? So this is what we call as the risk shifting, right? Meaning that I shift I remove the entire risk from myself, and then I impose the risk to this borrower, so that I can get a promised return. This is a promised return, right? Because regardless of what, I'm still getting my return. So I'm freeing myself from bearing this risk, right? But in the case of Islamic finance, Islamic banking, we are promoting this concept of risk sharing, right? You heard this, the using the contract of musyarakah murabaha. So meaning that in the case of myself and the borrower who want to borrow 1,000 from me earlier, right? So in the risk sharing, is different from risk shifting in the conventional lending, right? By having, the risk shared between me and this borrower, right? So now let's say that we shared the risk together, right? So I ask the borrower. So instead of I lend you the money, so now what if I invite you as become my partner, right? My business partner, right? So I'm going to give you 1,000, right? This 1,000 to you, and then you open a business venture here, sell whatever, right? Sell coconuts or whatever you want to sell, right? So 1,000, with 1,000, there's very limited amount of thing that you can sell nowadays. Right? Everything getting expensive, right? So let's say instead of I'm lending you the money, right, and get a fixed and confirm returns from you, so why not I'm proposing this? Why not I invite you to become my business partner, right? So we have a venture here, right? Selling a coconut, right? So you see now, the difference now is that we together bearing the same risk of this business being a failure. You get what I mean? So that's a slightly different from earlier, right? So this is the concept of risk sharing, right? So you will get to know this when you learn about Islamic banking instruments later, right? I don't want to go into detail of this, but you know the difference between risk shifting and risk sharing. So people argue that, especially you are from a Muamalat background, from Sharia background. So the ideal concept of Islamic banking must be revolved around this concept of risk sharing, right? So this is the most ideal way of doing financial intermediation earlier, right? Rather than lending, right? Lending, what I mean is the risk shifting, right? This is the most ideal concept of intermediation that we have been promoting in Islamic banking and finance, right? But let me ask you this, right? Do you think that those banks, right, will want to get involved in this kind of business if they have a choice of doing lending, like doing risk shifting, where their risk is protected, right? They will get a return, confirmed return from it, or they want to do this kind of business dealing that involves some level of risk. So do you think banks want to do that?
So I think most of them not want to not enjoy this risk sharing.
Right, because what they always give a reason that I have depositors back there that need some returns, right?
Yeah,
So
yeah.
if I risk myself putting myself into this kind of dealing with you as a borrower, I might not get a return for my borrowers, right? And then they will just get the money from my institution, from my banking institution, right? And then I don't get a return as well as a bank, right? I need some return as well.
Yeah.
So that's why you see that we have a level of, I mean, to a certain extent, have a difficulty in terms of promoting this concept of risk sharing, right? You need some infrastructure, you need some what we call as the environment or the ecosystem that allow this kind of risk sharing, right? So you need people are very trustworthy among each other, right? You can trust those people. People are very ethical, right? In the time of prophet, right? You don't have to be worried if you give money to somebody else. For sure, you know that you can honor the people. I mean, the people can honor you, right? They will remember that I borrowed the money from you, right? I need to get repaid, otherwise, I'm not being responsible, right? But in this kind of today's, I mean, I'm talking about today's situation, right? In the world that we are living here today, the situation is slightly different, right? We don't have that etiquettes, the concept of Islamic etiquettes anymore, right? So you have a problem when you want to apply this concept of risk sharing, right? I don't want to go into details, otherwise we don't have enough time to cover everything, right? So you are clear with the concept number 2, risk require compensation, right? Which is related to the concept of time of value just now. Okay, right. And then let me. Okay. So now we come to the third concept of money and banking, which say that information is the basis for any lending or investment decision. You cannot deny this, right? If you are investors or if you are lenders like banks, you need to know to whom you lend the money to, right? Because you need to understand whether they are able to repay you back, right? The concept here is about their ability to to repay the amount of money that they borrowed, right? So in the financial markets, we have this concept. I think you heard about this. We have this concept of asymmetric. Sorry, I have a bad spelling, right? Asymmetric information, right? If you are not from a finance background, perhaps this is something new, right? So you cannot. Anyone till now, right? Since they discovered this problem earlier, right? Many years, perhaps 100 years ago, right? I think until the end of the world, we cannot solve this problem of asymmetric information, right? Is going to be there in the financial markets. Now we're talking about financial markets, right? The concept of the problem of asymmetric information is like this, right? So let's say you have a two-party again, right? Okay, sorry. So one is lender. We give example here. Let's say put a bank, right? And then you have a borrower here. So now, as a what we're going to do a banking transaction here. So this bank will lend certain amount of money to this borrower, right? So again, to remember the earlier discussion that this bank who lend the money need to decide how much that I need to charge this borrower? I'm talking in the conventional perspective now, yeah. So so this lender need to decide how much money how much return that I need to charge these borrowers, right? So for the banks to decide on this, they need what? They need information. Oh, it's not working. All right. So this information is about what? Is about the credit quality, or we usually term as a credit worthiness of this borrower, right? In other words, to put simply, is that I need to know whether, as a lender, I need to know whether this borrower will be able to pay me back, right? So the lower the chances of this borrower do not have that kind of ability to pay me back. So I know that I need to charge him higher, right? Because I'm as a lender, I'm bearing a higher risk, higher level of risk now, right? So let me ask you this question, right? So who know the best about this credit quality information, about this credit worthiness of borrowers' information? Who knows the best, do you think? Who do you think know the best about this information? Anyone can give a response before we break for Margaret? Anyone?
The question?
So I'm saying that now we need to know, as a lender, they need to know this information about credit quality of those borrower, right? This borrower.
Yeah.
So my question now is that who are the party that know the best about this information, that have the most information about this credit quality of borrower?
The bank.
Okay, so Nia say the bank.
Because before giving the money, the bank will analyze whether he is credit worthy or not.
Okay, right. So that's will take place before. Usually, that's a common process, right? People will ask about your background, your employment, right? Your basic expenditure, monthly expenditure, whether you are able to know whether you want before you decide to lend the money. So that's normal procedure for any banks, right? But let me ask you this, Nias. But do you think that this information will cover everything, right? Is there any information that has not been disclosed to lenders?
I'm not sure about it.
Yeah. So that's
maybe guarantors, maybe.
Sorry, who's saying that? Guarantor?
Yeah.
Okay, let's say, okay, let put in the situation that you don't need a guarantor here, right? So guarantor is a come to different discussion again, right?
Okay.
So anyone else who can guess? Anyone? No? Right. So let me just add to what I explained to Nias earlier, right? So because borrowers, let's say you are just a small business operator, right? So you don't have uh, accounting or bookkeeping, right? So you don't have any accounting records, right? So usually banks will ask this: provide me with your bank statement. If you apply a loan, car loans, for example, bank will ask this, right? Give me your payslip, bank statement, and whatnot. So that's normal, right? But apart from this financial information, right, about your salary and whatnot, there are other information that has not been disclosed to lenders, right? Let's say, for example, I know that I have let's say I put myself into a borrower shoes now. So I'm a borrower now, right? I want to apply from this bank, right? So I may not disclose all informations, right? I may know something that happened to me in the next couple of time that I may not be able to repay the borrowings, right? So I may decided not to disclose this to lender, right? I know that probably I have some other family commitments, right? That I may not disclose this to lenders, right? So to answer the question earlier, who know the best is basically the borrower themselves, right? Borrower has the best, I mean, has the most information about him or herself being able to repay the money back, right? So this is what we call as the concept of asymmetric information, right? There's a what we call as there's a discrepancy between the level of information between borrower and lenders, right? Because of this lack of information, guess what's coming out from that? Risk, right? When you don't have information, you basically bear a risk. You need to bear certain amount of risk. So this is where the principle number 3 came about, right? He's saying that every lending and investment decision need information for you to make that kind of decision, right? So we have a problem of this asymmetric information everywhere in the markets. Nobody can come to you and say that I've solved this problem of asymmetric information. Nobody can be sure about that, right? Do you agree with me? Right? Okay, so far, good, so good.
We can use the term false information or wrong information. Why asymmetric? The term asymmetric. Why are we using this term?
Okay. What you call it as? What is the opposite of asymmetric?
Symmetric.
Symmetric, right? What do you understand about something that is being symmetric?
Like something straight or
parallel, right?
Parallel.
It's a parallel dimension, right?
Right,
so
right.
if I have something that stand like this, I have another one that stand at the same position, right?
Exactly.
So, but when you have asymmetric, what happened? Something that is not right. Something that is lose the balance. Something that is not something that is imbalanced, right? So this is the problem. What we call as the asymmetric information, which is the opposite of symmetric. So now we have imbalance of information here. We have information which is slightly more at the hand of borrowers in terms of their the ability of pay the money back, right? But lenders and banks have this problem where they have an insufficient amount of information, right? So let's say if I have let's say put in this hypothetical situation, right? So let's say what if I've come up with some brilliant mathematical formula that solves this asymmetric information problem, right? So I probably get a Nobel Prize for that, but that's not going to happen. So let's say if I solve this kind of problem now, so now lenders and borrowers have the same information, right? I brilliantly come with something that can these both party have equal amount of information, right? So what happened to borrowers here is that borrower will say that why you should charge me money, right? Because you know that what you be getting repaid, right? So for sure you know that I'm being able to repay you back, right? So you bear no risk at all. So why you should pay and charge me with some amount of interest or returns, right? Because you have all level of information, then you can be sure that I'm able to pay you back, right? So there shouldn't be any risk that you bear as a lender. Do you agree with me? Yes.
Yes, sure.
Yeah. So when you have that kind of parallel information, there's no problem of bearing a risk in the financial markets, right? So
Right.
we can and then again, nobody can be sure about this, right?
Right.
So although you have that information about borrower, let's say we have come again in that situation when we have the parallel situation, we have the parallel information between lenders and borrowers. But can you tell something that will happen tomorrow, right? Nobody is going to predict that there's a aircraft fell in China today, right? So nobody is expecting that. So that's very uncertain future, right? So that's why you cannot run from this concept of risk. Okay.
Okay.
All right. Okay. So now we have this kind of new, for those people who are very high tech people, right? So people are using wearables or this. I don't have one. Usually they have this fitness watch, right? That you can monitor your heart rate, your condition, your health condition, right? And then you basically can keep track, right? Your whether you are in a good health or bad health, right? With this kind of information, again, it will bridge a bit the gap between lenders and borrowers. That's what I'm trying to say, right? So let put in the case of insurance company, right, or takaful company, right? So you have a takaful operator, right? Let's say AIA. Okay, and then I have this insured person, right? Who pay for the subscription of the takaful, right? So takaful operators say that I will cover you in the case of any illness, right? In the next, let's say, 30 years from now, right? But for providing you that kind of services, that protection to you as an insured person, I will charge you some fees, right? This is the concept of takaful, right? So because of, again, I don't, who knows the best situation about this insured person health condition is the insured person themselves, right? They know about their condition, although you can do some due diligence. Of course, Nia said that this takaful operator will ask you to fill some form, right? Disclose all your previous illness and whatever, right? But again, nobody can be sure what happened to himself and to others, right? In the next period of time, right? You never know what happened to that, right? So what I'm trying to say here is that when you have this access to like gadgets, right? The health monitor, whether it's using phones or using your watch, right? So these gadgets, right, are able to collect some information about your health condition, right? But the thing is that now we have yet to merge this data together, right? So now you have a financial information about this insured company, and then you have a non-financial information. This is about your health condition, your sickness or whatever that has been traced by your gadget, right? So let's say now let's say we move forward in the next 20 years or 30 years, right? At that time, these company operators are able to track your health as an insured person using these wearables, right? So meaning that it automatically transfer the information to the takaful operator, for example, right? So in this case, by having this kind of technology, you bridge the gap of information here, right? So as an insured person now, should I be asking this takaful operator to reduce the fee a bit? Should I? And you as a takaful operator, should you do that? Anyone can respond? You should or you shouldn't. Apply the same concept of information again, the asymmetric information just now.
I will try not to give that information, but the company will compel me to give that information very shortly or within a year or so.
Yeah. I'm talking now. Let's say I say that we move forward 30 years, right? At that time, this Takaful operator have the access to that information. No worries, right? Mm-hmm. But I'm asking now. I'm asking now is that should the fees be reduced? The cost of this financial instrument, which is the insurance, has been reduced?
Yes, it should.
It should be reduced, right? Because now we will say that this Takaful operator will bear a slightly low risk as compared to 30 years back, right? Because 30 years back is that they don't have this kind of information, right? But now, since they have this access to information, they should transfer the reduction of the risk to the insured person, right? So this person will need to pay a slightly low cost of low fees of this kind of insurance products, right?
Yes.
So you see that's the benefit of having this financial technology, right? So if you are interested in fintech and whatever, you should read this kind. It's very interesting, right? Although I'm not that kind of interested in this, right? But you can see the application or the concept or the benefits of this financial technology will do to the current business, the current financial or banking activities that we have now, right?
Yes.
Okay, right. So right. So it's already 7:30, right? Should I continue? Man, I'm not gonna finish this by today as well. We are still in the first lecture, right? It's okay. I hope we can at least we have time to look at a bit on the second topic, which is on money and payment system after Maghrib, right? So let's just take a quick break for prayers, and if you haven't had dinner yet, hopefully you can have your dinner, and then we come back at 8. Can we come back at 8?
Yes, sure.
Okay, all right. So I stop the recording now. We meet up at 8 o'clock. Yeah. So I will start sharp at 8. Yeah, because I need to rush a bit because of the time limit. All right. Okay. I'll see you after Maghrib, inshallah.